Friends, thank you for being here today. We live on a planet of debt. This is not a metaphor. It is the fundamental mathematical reality of our modern global system. Nearly every country on earth, regardless of its political structure, economic model, or national wealth, owes staggering sums of money. The United States, the world's largest economy, currently carries a national debt exceeding $38 trillion, a figure that continues to climb to new historic highs. The collective debt of the European Union nations hovers around $14 trillion across the globe. In Asia, Japan, an economic powerhouse, contends with a debt of approximately 9 trillion. Even nations one might assume are immune oil rich states like Saudi Arabia or export driven giants like China and Germany are all, in fact, enormous debtors. The total global debt, encompassing all government, corporate, and household borrowing, now exceeds an almost incomprehensible $315 trillion. This is a sum nearly 3 times the size of the entire global economy, a valuation of every good and service produced by all of humanity in a year. What if I told you that this entire $315 trillion mountain of debt is not actually designed to ever be paid back? And what if I told you that the very act of trying to pay it off would trigger a global economic collapse worse than anything history has ever seen? This universal condition presents a profound and deeply unsettling paradox. If every nation is borrowing, if everyone owes, then who precisely is the creditor? To whom does the world owe this colossal planet spanning fortune? It is the most important financial question of the 21st century, and its answer reveals that the simple logic of a household loan where one person borrows from another does not apply. The truth is far more complex and circular. The world, in a strange and convoluted way, owes this money to itself. This, however, is not some simple accounting trick that cancels itself out. The debt is very real and it has consequences. It is the invisible architecture of the modern world, a scaffolding of IOUs upon which every war, every crisis, every period of boom, and every devastating bust is built. This system does not benefit everyone equally. To understand how we arrived at this precarious point, we must first trace the genesis of this idea, an invention that would come to define the very nature of money, power, and the state itself. Now, this system wasn't built overnight. To really understand how we arrived at this point, we have to trace the genesis of sovereign debt. Long before the first digital transfer or credit card swipe, the concept of debt was simple. It was a personal promise, an act of trust between neighbors. A farmer might lend a neighbor a bag of grain in the spring to be paid back with a little extra during the fall harvest. It was a tool for survival, a way to borrow from tomorrow to solve the problems of today. For millennia, this was the extent of debt, a personal, tangible obligation. The transformation of debt from a personal promise to an instrument of national power began, as so many financial innovations do, with the urgent necessities of war. The year was 1694. England was locked in a costly and draining conflict with France, and the crown's coffers were empty. The king needed money for ships, cannons, and soldiers, but the traditional sources of wealth had run dry. In a moment of revolutionary ingenuity, the government turned not to other kings, but to its own merchants. A deal was struck. In exchange for a massive loan to finance the war, the merchants would receive a permanent, guaranteed stream of interest payments backed not by the king's fluctuating fortunes, but by the full faith and credit of the nation's future tax revenues. To manage this new arrangement, a new institution was chartered, the Bank of England. This single act changed everything. The state was no longer constrained by the gold it held in its vaults. It could now spend money it did not yet have. In return, the lenders received something priceless, a tradable, sellable promise from the government the world's first modern government bond. This piece of paper was the seed from which our entire financial system would grow. The concept was too powerful to remain contained. France soon copied it. The Netherlands refined it. The newly independent United States of America adopted it to fund its revolution against the British and later to finance its westward expansion. National debt, once seen as a mark of failure or royal profligacy, was recast as a measure of credibility. The ability to borrow became synonymous with the ability to rule. Where empires once conquered territory to extract gold, they now issued bonds to extract interest. The balance sheet had become the new battlefield. This system was supercharged in the 20th century. The unprecedented industrial slaughter of World War I and World War II forced nations to borrow on a scale never before imagined, not only to finance the fighting, but to rebuild entire continents from the rubble. In 1944, at the Bretton Woods Conference, the victorious Allied nations cemented a new global order. The United States dollar, then redeemable for a fixed amount of gold, was anointed as the world's primary reserve currency. This system held for a few decades, but it had a fatal flaw. The global economy was growing and it needed more money to function, but the supply of gold was limited. The United States, funding both a domestic Great Society and a costly war in Vietnam, was issuing more dollars than it could possibly back with the gold in Fort Knox. In 1971, President Richard Nixon made a fateful decision. He unilaterally severed the dollar's link to gold forever. This event, often called the Nixon shock, ushered in the era of pure fiat currency. From that moment on, money was no longer backed by anything physical. Its value was derived entirely from government decree and, more importantly, from the collective trust and confidence placed in that government. This was the recipe for an explosion of endless borrowing. If money was no longer a scarce commodity but an abstract concept, then debt, its creative force, had no theoretical limit. That explosion of borrowing brings us to some fundamental questions. Before we explore the consequences of this system, we have to be precise about what national debt actually is, and perhaps more importantly, why governments seem so addicted to borrowing. When we speak of a country's national debt, also known as public or sovereign debt, we are referring only to the total amount of money owed by its central or federal government. In the case of the United States, this figure does not include the separate debts taken on by the 50 states, nor the debts of cities or counties. Furthermore, it has nothing to do with the personal private debts of its citizens, their mortgages, student loans, or credit card balances, which are themselves another mountain of obligations. The national debt is purely the IOU of the central government. Given the risks, why do governments willingly plunge themselves into this ocean of debt? Why not simply live within their means like a prudent household? The first and most common reason is to cover budget deficits. A government's primary income is tax revenue. However, the public's demand for services, education, healthcare, pensions, a standing military, public safety is often greater than the amount of money collected in taxes. When a government spends more than it earns in a year, it runs a deficit. If a government collects $3 trillion in taxes but has budgeted for $4 trillion in spending, it has a $1 trillion gap. It has only three options. It could cut spending, but this means firing teachers, closing hospitals, and reducing pension payments, actions that are politically toxic and can lead to mass unrest. It could raise taxes, but this is equally unpopular and can slow down the economy. The third option, the path of least political resistance, is to borrow the $1 trillion by issuing bonds, promising to pay it back later. The second reason is to invest in growth. Not all debt is created equal. Borrowing to fund daily operations is one thing. Borrowing to build a productive asset is another entirely. Imagine a country that needs new ports, highways, a stable power grid, and high speed internet to compete in the global economy. It could wait decades, patiently saving up tax revenue to build these things one by one. Or it could borrow the money today, build all of it at once, and create a more productive, efficient economy. The theory is that this investment will generate more economic growth, which in turn will create more tax revenue, making the debt easy to pay off in the future. This is good debt, at least in principle. Third, governments borrow to manage crises and emergencies. This is not a choice, it is a necessity. When an unexpected disaster strikes a catastrophic earthquake, a banking collapse, or a global pandemic, a government must act immediately. In the year 2020 alone, the United States government borrowed an astonishing $3.8 trillion, dollars, about 18% of its entire economy, to fund stimulus checks, business aid, and vaccine development in response to the COVID 19 pandemic. Without this borrowing, the economic collapse and human suffering would have been exponentially worse. Fourth, governments borrow as a tool of economic stabilization. This is a more technical function. By issuing and buying bonds, a government and its central bank can influence the entire economy. If inflation is too high, the government can issue bonds to pull money out of the economy, taming prices. If the economy is in a recession, it can borrow and spend, injecting money into the system to stimulate growth. Finally, and most circularly, governments borrow money for the express purpose of paying off existing debt. A government may have a 10-year bond from 2015 that is due to be paid back in 2025. If it doesn't have the cash on hand, it simply takes out another loan in 2025 to pay back the first one. This leads us to the system's most crucial secret, which we will explore later. The principal is almost never paid back. At this point, a persistent question arises: why go through this elaborate charade of borrowing at all? If the government can issue bonds, why not just skip the middleman and print the money it needs? The answer is discipline. As the catastrophic hyperinflation in nations like Venezuela and Zimbabwe has shown, when a government gives itself the power to print money without restraint, it will. This floods the economy with cash, destroying its value, wiping out savings, and leading to total economic and social collapse. Borrowing, by contrast, creates a feedback loop. Because debt comes with an interest payment, it forces a degree of responsibility. The government must maintain the confidence of its lenders, or the entire system will come crashing down. This, of course, leads us back to that central paradox. If governments are borrowing on this colossal scale, who on earth has trillions of dollars to lend? The popular imagination often conjures images of shadowy, all powerful figures in back rooms, but the reality is far more mundane and, again, far more circular. The debt isn't held by one entity, it's woven into the very fabric of our financial lives. The lenders fall into four main categories. The first and largest category is domestic lenders. This is the component of the debt that a nation owes to itself. When you buy a simple government savings bond, you are lending money to your country. When you deposit your paycheck into a bank account, the bank doesn't let that money sit in a vault. It puts it to work. And one of the safest ways to do that is by purchasing government bonds. In the United States, commercial banks hold nearly $1.8 trillion of US debt. The money in your retirement account, your 401k, or your pension fund is managed by massive funds that have a legal duty to keep it safe while earning a steady return. For them, government bonds are the perfect low risk asset. Insurance companies, which need to be sure they can pay out future claims, are also massive holders of bonds. Even the government itself is a domestic lender. This is called intragovernmental debt. The US Social Security Trust Fund, for example, has collected more in taxes over the years than it has paid out in benefits, it invests this surplus as required by law in special government bonds. In effect, one part of the government, Social Security, is lending money to another part, the Treasury. It is a 200-page IOU that the government has written to itself. The second category is foreign lenders. These are other countries, foreign banks, and international investors. Just like your pension fund, they buy bonds as a safe investment. Foreign governments, in particular, buy massive quantities of other nations' bonds, holding them as foreign exchange reserves to help stabilize their own currencies. This is why you often hear that China or Japan is funding US debt. It is true to an extent. Japan holds approximately $1 trillion of US debt, and China holds around $800 billion. However, this is a much smaller piece of the pie than most people believe. For instance, China's holdings account for only a tiny fraction, perhaps 2 or 3% of the total $38 trillion US debt. The vast majority of America's debt is owed to America. The third category is international institutions, which function as lenders of last resort. When a developing country needs long term funding for a massive infrastructure project, like a dam or a national highway, it might borrow from the World Bank or a regional equivalent, like the Asian Development Bank. These institutions provide low interest loans for specific development goals. But when a country is in the midst of a full blown financial collapse, when it is broke and no one else will lend to it, it makes a desperate call to the International Monetary Fund, IMF. The IMF does not fund projects. It provides emergency loans to prevent a country from defaulting. These loans, however, come with severe and controversial conditions, often called austerity demands, that the government drastically cuts spending, raise taxes, and sell off state owned companies. Finally, the fourth and most powerful category of lender is a nation's own central bank. Institutions like the US Federal Reserve or the European Central Bank are the ultimate market makers. They have a unique power. They can create new money out of thin air and use it to buy government bonds, typically from commercial banks, in a process known as quantitative easing. This injects new money into the economy, keeping interest rates low and ensuring the government can always fund itself. The liability of one balance sheet, the government's bond, becomes the asset of another, the central banks. This is the mechanism by which debt itself is turned into money. Every dollar in your pocket or digital number in your bank account exists only because a corresponding unit of debt was created somewhere else in the system. All of this brings us to the most profound and least understood concept in modern finance. It's what I'd call the big secret of the entire system, and it's this: sovereign debt is not designed to be repaid. Not now, not ever. That sounds strange, I know. When you or I take out a loan for a car or a house, we are expected to make payments that cover both the interest and the principal, eventually paying the debt down to zero. We instinctively apply this same logic to national debt, leading to panic calls to balance the budget and pay off the debt. But this is not how governments operate. This is not a conspiracy, it is a stated and necessary policy. Governments practice what economists call refinancing, or more simply, rolling over the debt. When a 10-year bond from 2015 comes due, the government does not use tax revenue to pay back the principal. Instead, it simply issues a new bond and uses the money from that sale to pay off the holder of the old bond. The total amount of debt remains the same, or more often increases. It has just been rolled over for another 10 or 30 years. The government, in effect, treats its debt like a rolling subscription, and the interest is the monthly fee. As long as the government can afford to pay the interest, the subscription can be renewed indefinitely. The reason this is possible and, in fact, necessary is that government debt, particularly the debt of a stable country like the United States, is not viewed as a risky liability. It is viewed as the safest and most desirable asset on earth. It is the foundational collateral for the entire global financial system. Banks use it as security for their own lending. Pension funds use it as their bedrock guarantee. Central banks treat it as money itself. This leads to the ultimate paradox. If a major country, like the United States, actually tried to pay off its entire $38 trillion debt, it would be the single most catastrophic event in financial history. To do so, it would have to pull $38 trillion out of the economy and give it back to bondholders. This would instantly vaporize the world's money supply, triggering a deflationary spiral so severe it would make the Great Depression look like a minor recession. Furthermore, it would destroy the world's most trusted financial instrument, the very asset upon which all other financial values are built. The system therefore depends on the debt never being paid off. It requires a constant rhythmic issuance of new debt to keep the machine turning. The goal is not elimination. The goal is sustainability, keeping the debt at a manageable level relative to the size of the economy and ensuring that interest payments remain serviceable. The debt has become a kind of heartbeat for capitalism itself, pulsing through every pension, mortgage, and market on earth. So, if the debt is never meant to be paid back, and if it's the very foundation of the system, does that mean it's a perpetual motion machine that can run forever without consequence? The answer is a definitive no. This is where we have to talk about the risks. The entire edifice is built on a single, intangible, and fickle foundation: confidence. The system works only as long as investors, markets, and other nations believe that a government will always be able to make its interest payments. When that confidence wavers, the machine grinds to a halt and the invisible architecture collapses. The first and most insidious risk is the debt trap, also known as the debt death spiral. This occurs when a country's debt has grown so large that it is forced to borrow new money just to pay the interest on its old loans. It is the sovereign equivalent of using one credit card to pay the minimum balance on another. At this point, the debt becomes self perpetuating. Interest payments, which produce no economic value, begin to consume a larger and larger slice of the government's budget. In the United States, net interest on the debt is projected to cost over $880 billion per year, more than the entire military. This is money that cannot be spent on schools, hospitals, or scientific research. This is the primary risk for many developed nations, not a sudden collapse, but a slow, suffocating squeeze on all other public priorities. The second risk is inflation. If a government finds itself unable to borrow more money from the market, perhaps because investors are getting nervous, it may be tempted to force its own central bank to print money to cover its debts, a process called debt. Monetization. This is a short term fix with disastrous long term consequences. By flooding the economy with new money, it devalues the currency. The debt is inflated away, it becomes easier to pay back, but only because the money used to pay it is worth less. This is a default in all but name, a stealth tax that robs savers of their purchasing power and can spiral into hyperinflation. The third risk is the market itself, embodied by the bond vigilantes. These are not a formal group, but the collective, anonymous power of the market. The hedge funds, pension funds, and major investors who buy and sell bonds. They are the true arbiters of credit. For decades, they may seem dormant, happily lending money at low interest rates, but if they perceive a government is becoming reckless, they will revolt. They will stop buying bonds or, more likely, demand a much higher interest rate to compensate for the perceived risk. We saw this in dramatic fashion. In the United Kingdom, in the autumn of 2022, the new government of Prime Minister Liz Truss announced a mini budget of massive unfunded spending and tax cuts. The market, the bond vigilantes, took one look and panicked. They collectively decided the UK's plan was not credible. They went on strike, refusing to buy UK bonds, and started selling what they had. The price of bonds collapsed, which caused interest rates or yields to spike. Mortgage rates across the country doubled overnight. The pension system teetered on the brink of collapse. Within weeks, the Bank of England was forced into an emergency intervention, and the Prime Minister was forced to resign. This is the power of the market to enforce discipline when politicians will not. The final and most catastrophic risk is a sovereign default. This is when a country simply and openly says, we cannot pay. The consequences are immediate and total. The country is instantly locked out of the global financial system. Its currency becomes worthless. Imports of food, fuel, and medicine cease, banks close, the economy implodes. We have seen this play out in recent years in Greece, which in 2010 led to mass unemployment and a generational crisis. We saw it in Sri Lanka in 2022, which led to the government's collapse amid massive fuel shortages and civil unrest. And we have seen it repeatedly in Argentina. A default is the financial heart attack, the moment the illusion of confidence evaporates completely. But a sovereign default is almost never an isolated event. It doesn't just happen in a vacuum, affecting only the citizens of that one nation. In our tightly interconnected global system, a default is a virus. It is called contagion, and it spreads through the very channels that make our system so efficient. The banks. When Greece teetered on the brink of default, the panic wasn't just in Athens, it was in Frankfurt, Paris, and Berlin. Why? Because major German and French banks were sitting on their balance sheets holding billions of dollars worth of Greek government bonds, which they had long considered safe assets. If Greece defaulted, those safe assets would instantly become worthless, blowing a hole in the bank's finances. A default in Athens could have triggered a banking collapse in Germany, which in turn would have frozen the entire European economy. This is contagion. One domino falls, and it threatens to topple the whole row. In Europe, this fear gave rise to a particularly nasty concept known as the doom loop. It works like this. First, a government, say Italy or Spain, gets into financial trouble. Investors get nervous and start selling its bonds, causing their value to fall. Second, the nation's own banks, which are often the largest holders of their home government's bonds, suddenly see the value of their core assets collapse. This puts the banks on the verge of failure. Third, who is responsible for bailing out the failing banks? The government. But the government, already in trouble, must now borrow even more money, which it can't, to save its banks. This borrowing makes its own debt situation worse, which causes its bonds to fall even further, which hurts the banks even more. It's a self-feeding spiral that circles downward until the entire system implodes. This is where a group of obscure but incredibly powerful players enter the game, the credit rating agencies. You've heard their names, Standard and Poor's, Moody's, and Fitch. Their job is to act as the official arbiters of confidence, assigning a letter grade like AAA, BB plus, or C to nearly every bond in the world. These grades aren't just an opinion, they are hardwired into the rules of the financial system. Many of the world's largest pension funds and insurance companies are legally forbidden by their own charters from holding bonds that are rated below a certain level known as junk status. This gives the rating agencies terrifying power. A simple downgrade from one of these agencies is not just bad press, it can be the trigger that starts the avalanche. If an agency downgrades a country's debt to junk, thousands of funds around the world have no choice but to sell those bonds immediately. This forced mass selling is what begins the bond vigilante attack, causing interest rates to spike and turning a manageable problem into an acute crisis overnight. This even happened to the United States. In 2011, amid a political standoff over the debt ceiling, S&P downgraded the US from its perfect AAA rating for the first time in history. The stock market plunged. It was a clear signal that not even the linchpin of the system is immune from the judgment of the confidence game. So you see, the risks aren't just mathematical, they are deeply psychological. The line between a sustainable debt load and a catastrophic one is not a fixed number. It is a fragile collective belief. And when that belief breaks, it breaks all at once. This delicate balance of confidence and risk isn't uniform across the globe. Every country plays a different role in this complex machine. And when you look at the global picture, you see a world perpetually on the edge. The United States is the linchpin of the entire system. Because the US dollar is the world's reserve currency and US Treasury bonds are the global safe asset, it enjoys what has been called an exorbitant privilege. It can borrow in the currency it prints, a luxury most other nations do not have. But this privilege is not unlimited. The US is currently running a budget deficit of 6 to 7% of its economy, a level that is extraordinary during a time of peace and low unemployment. The greatest systemic risk to the global economy, therefore, is not a default in Sri Lanka, but a loss of confidence in the US Treasury, a Liz Truss moment on a global scale. Japan presents a fascinating counter argument. Its debt to GDP ratio is the highest in the developed world, exceeding 250%. Yet, Japan has faced no crisis. Its interest rates remain near zero. Why? Because unlike the US, Japan's debt is almost entirely held domestically. It is a closed loop system where the Japanese people and the Bank of Japan are the creditors. The nation owes the money entirely to itself, and its stable, high saving population has been willing to fund this system for decades. China, meanwhile, faces a different problem. While its central government debt is opaque, its internal debt, driven by regional governments and a superheated property market, is staggering. China now faces slowing growth, a demographic crunch, and a debt bubble that threatens to burst, drawing many parallels to Japan's lost decades of stagnation. Finally, the Eurozone remains a fractured picture. It has a single central bank, the ECB, but 19 different governments with 19 different budgets. Germany, the traditional poster child for fiscal prudence, has been reluctant to borrow, but is now being forced to increase spending on its own defense and energy transition. Meanwhile, nations like Italy and France have high debt levels and face immense political difficulty in reining in spending, creating a constant source of tension within the Union. So, this brings us back to the paradox we started with. If everyone owes, who is the real creditor? The simple answer is we owe it to ourselves, but this masks a more complex and uncomfortable truth. We is not a uniform entity. The modern debt system is also a vast engine for the transfer of wealth between classes. Think of how it functions. Interest payments on the national debt are funded by general tax revenue, which is collected from the entire population, workers, consumers, and corporations. And to whom do those interest payments flow? They flow to the owners of the bonds, the commercial banks, the large investment funds, the wealthy individuals, and the pension funds. While many working people do benefit indirectly through their pensions, the overwhelming flow of wealth is upward from the general taxpayer to the asset owning class. It is no coincidence that the era of exploding global debt has also been the era of exploding global wealth inequality. The system rewards those who own the debt and taxes those who must service it. The modern world is addicted to this system. Debt fuels our growth, funds our crises, and supports our retirements. We cannot live without it. But this reliance has trapped us in a cycle. When the bill comes due, governments are perpetually faced with an impossible choice between three painful options: austerity, politically unfeasible; inflation, a stealth default on the public; or default, a financial catastrophe. Debt, in the end, is a double edged sword. It is the tool that built the modern world, an ingenious human invention that allows us to build a better future by borrowing from it. But used recklessly, it is a promise that cannot be kept forever. It is an architecture of invisible IOUs, a scaffolding that supports our global economy, but one that grows heavier every single day. The greatest challenge of the 21st century will be to manage this awesome power, to ensure that the scaffolding that holds us up does not become the cage that traps us.